All right, listen up, people. We're diving headfirst into the wild world of futures for mid-2025. You want to know what's hot and what's not? You came to the right place. Futures contracts, these are agreements to buy or sell something later at a price locked in today. Think commodities, currencies, stock indexes, the whole shebang. It's where the smart money plays, and it's where fortunes are made or lost if you're not careful. But don't you worry, because I'm here to light the way. We're talking about predicting the future, and that's exciting. It's about getting ahead of the curve, understanding the global chessboard, and making those big, bold moves. This isn't for the faint of heart, but the reward's huge. Now, to make this simple, because I like simple when it comes to profits, I've got my very own rating system. It's easy to understand, it's powerful, it's designed to make you money. We've got a scale from 1 to 5. 1 is a strong buy. That means you jump on it, you load up the truck, you don't look back. 2 is a buy. Still good, still a green light, get in there. 3 is stable. Means it's holding steady, treading water. Not much action, but not a disaster either. 4 is a sell. Time to take profits, get out, wave goodbye. And 5, that's a strong sell. Run for the hills. Don't touch it with a 10-foot pole. This system is your secret weapon for navigating these choppy market waters. So how do you use these ratings? It's not just about looking at a number, folks. It's about understanding the why behind the number. I'm going to break down the key factors, the global trends, the geopolitical bombshells that are moving these markets. You've got to connect the dots. A strong buy in wheat isn't just a win. It's based on weather patterns, global demand, and supply chain nightmares. A strong sell in crude oil isn't just me being a party pooper. It's about a fundamental shift in energy consumption. These ratings are your starting point for your own homework, your own deep dive. Think of them as the flashing green or red light at the intersection of profit and peril. But let me be clear, crystal clear, I'm giving you my best calls, my high-octane analysis. However, you always do your own homework, always. The market is a beast and it can turn on a dime. My job is to give you the insights, the perspective, the Kramer confidence to make informed decisions. This isn't financial advice gospel, it's a battle plan. We're looking at mid-2025. A landscape full of opportunity and pitfalls. So strap in, because we're about to go on a whirlwind tour of what you should be buying and selling. Let's make some money. Are you ready? Booyah! First up, the bread and butter of the commodities world, literally. Hard grains are looking hotter than a summer sidewalk. Let's talk wheat. I'm pounding the table on this one. Strong buy. Why? Global food security is no joke, people. We've seen supply chain disruptions that are still echoing. We've got weather patterns that are just plain nuts in key growing regions, droughts here, floods there. And demand? It's relentless. Every country needs wheat. It's a staple. It's fundamental. Don't overthink this one. The world needs to eat, and wheat is at the top of the menu. This is a momentum play backed by solid fundamentals. Next on the shopping list, corn. Oh, baby, this is another strong buy. Corn is not just for your summer barbecue anymore. The demand for biofuels, especially ethanol, is roaring back as countries try to meet their green energy targets. And let's not forget animal feed. The global appetite for meat, while facing some headwinds we'll discuss later, still requires massive amounts of corn to feed livestock. Plus, China is always a huge buyer, and their import needs are looking strong. This isn't just a crop, it's an industrial powerhouse. Get in on this golden goodness before everyone else wakes up and smells the profits. This is a no-brainer. And rounding out our grain trifecta is soybeans. You guessed it, another strong buy. The plant-based protein trend is not a fad, it's a revolution, and soybeans are at the heart of it. Tofu, soy milk, edamame, the demand is exploding worldwide. Beyond that, traditional uses in animal feed and soybean oil are rock solid, crushing margins. That's the profit crushers make, turning beans into meal and oil. Are looking fantastic. This is a multifaceted demand story that you cannot ignore. The versatility of soybeans makes them a must-own in this inflationary environment. This is where you want to be. So wheat, corn, soybeans, this isn't just farming. This is a license to print money in mid-2025. These three musketeers of the grain world are all screaming strong buy. Geopolitical tensions continue to simmer, impacting Black Sea exports. Weather volatility is the new norm, and underlying demand is unwavering. These commodities are also a fantastic hedge against lingering inflation. Don't be shy, don't be timid. The signals are clear. Load up the combine harvester and rake in those profits. This is the kind of setup we dream about. All right, let's move from the fields of gold to some other agricultural plays, the softs. And here, the picture is a bit more mixed. But there's one shining star: cotton. I'm telling you, cotton is a strong buy. The fabric of our lives is back in vogue. Fashion demand, despite economic jitters, has proven remarkably resilient. Consumers are still buying clothes. More importantly, supply is the real story here. We're seeing persistent issues in major cotton-producing regions like India and the United States due to weather and policy. That means tighter bales and higher prices. This is a classic supply-demand squeeze play, and you want to be on the right side of it. Now, let's talk about coffee. Coffee. I love my morning cup, but as an investment for mid-2025, I'm more lukewarm. I'm slapping a sell on coffee futures. Why the bitter taste? We're looking at potential oversupply. Brazil, the world's coffee king, is expecting a bumper crop. Weather conditions there have normalized, which is great for them, but not so great for prices. Vietnam, another major producer, is also looking strong. While global consumption is steady, it's not growing fast enough to absorb all this potential supply. So enjoy your latte, but maybe steer clear of the futures contract for now. There are better places to park your cash. What about rice and orange juice? For these, I'm seeing stable to a cautious sell. Rice is a staple for billions, yes, but the global market is often heavily influenced by government policies and regional factors, making it tricky. There isn't a screaming global shortage or demand boom that excites me right now. Orange juice has been plagued by citrus greening disease for years, which has kept prices somewhat supported. However, consumption trends for OJ have been flat to declining in many Western markets. It's a niche play, and unless there's a major weather disaster in Florida or Brazil, I don't see a big upside. Too much risk for too little reward. And finally, sugar. This one is a definite no-go for me. I'm rating sugar a strong sell. The writing is on the wall, folks. Health consciousness is a massive global trend, and sugar is public enemy number one. Governments around the world are implementing sugar taxes, hitting demand for sugary drinks and processed foods. On the supply side, production in key countries like Brazil and India is looking robust. This combination of falling demand and strong supply is a recipe for price disaster. Don't get caught with a sweet tooth in this market. Avoid, avoid, avoid. There are no sweet dreams to be had here. Let's move on to the meat and dairy complex, and frankly, I'm not wildly bullish here. It's a mixed bag, leaning towards stable or even bearish for mid-2025. First up, live cattle. I'm pegging this one as a stable, but with a definite bearish tilt, maybe even a sell if things don't improve. Feed costs, driven by those strong grain prices we just talked about, are a major headache for cattle ranchers, squeezing their margins. On the demand side, consumers are feeling the pinch of inflation. Beef is expensive, and shoppers might be trading down to cheaper proteins or simply buying less. Export markets are competitive. It's a tough environment. Next, lean hogs. This one looks even less appetizing. I'm calling lean hogs a sell. For a while, African swine fever (ASF) outbreaks, particularly in Asia, were a huge driver of price volatility and upside. But the impact of ASF seems to be waning as herds are rebuilt and biosecurity measures improve. Global pork production is ample and export markets are incredibly competitive. There's just too much uncertainty and not enough clear upside catalysts for me to get excited about hogs right now. I'd rather put my money to work in markets with clearer, bullish narratives. This little piggy is not going to market for me. Now, what about milk and other dairy products? I'm rating this sector stable. Fluid milk consumption, especially in developed countries, has been on a long-term downtrend. People are switching to plant-based alternatives or simply drinking less milk. Cheese demand has been a bit more resilient, which offers some support. The global dairy trade, often gauged by auctions like the Global Dairy Trade (GDT) events, will be the key indicator to watch. Right now, it's not signaling a major price boom. It's just stable, not exciting, not disastrous, just chugging along, not where the big money is going to be made. Overall, the entire protein sector, traditional meats and dairy, is facing some significant headwinds in mid-2025. As I mentioned, high feed costs are a persistent issue. The rise of plant-based alternatives continues to chip away at market share, especially among younger consumers. And economic uncertainty can lead consumers to tighten their belts, often starting with more expensive food items like red meat. This isn't the sector for explosive growth next year. You're better off looking elsewhere for those home-run trades. This is a time for caution in the meat aisle. Section 5, energy shockers, nat gas sizzles, crude fizzles. All right, let's talk energy. This is where the sparks fly. And for mid-2025, we've got a tale of two very different fossil fuels. First, let's look at natural gas. I am bullish on nat gas. I'm rating it a buy. Europe is still scrambling to diversify its energy sources and reduce reliance on unpredictable suppliers. This means a sustained demand for liquefied natural gas, and the US is a kingpin in LNG exports. Natural gas is also seen as a crucial transition fuel, cleaner than coal, and a reliable partner for intermittent renewables like solar and wind. This isn't just a short-term blip. It's a structural shift. We all remember the insane price spikes in natural gas. While things have settled down from those crazy highs, the price floor is definitely higher than it used to be. Storage levels going into the winter heating season will be absolutely critical to watch, both in the US and Europe. Any unexpected cold snaps or supply disruptions could send prices rocketing again. This isn't just a commodity, it's a strategic asset in the current geopolitical climate. The demand from industrial users is also robust. This is a smart, calculated play on the evolving global energy map. Get ready for some gas-powered profits. Now let's flip the script and talk about crude oil. And here, my friends, I have to be blunt. No! Crude oil is a strong sell for mid-2025. The party's over for big oil, at least for a while. Global economic slowdown fears are very real, and when economies slow, demand for oil takes a nosedive. Think about manufacturing, transportation, travel. It all gets hit. OPEC Plus can try to manage supply with production cuts, but they can't hold back the tide forever. Plus, we're seeing production creeping up in non-OPEC countries that are eager to cash in. But the biggest, most fundamental reason for my bearishness on crude: the green revolution is here, and it's accelerating. Electric vehicle adoption is no longer a niche market. It's mainstream and growing exponentially. Every EV on the road means less gasoline demand. Investment in renewable energy, solar, wind, hydrogen is absolutely massive. We are past the point of peak oil demand, folks. Peaked. It might not fall off a cliff tomorrow, but the long-term trend is undeniable, and the mid-2025 outlook reflects this shift. Don't get caught holding the barrel when the music stops. Sell, sell, sell. Section 6. Metal mania, palladium power, copper calm. Let's dig into the metals market. Industrial, precious, they all tell a story. And right now, one metal is shining brighter than all the rest. Palladium. Booyah! This is a strong buy, people. Palladium is a critical component in catalytic converters for gasoline-powered cars, helping to reduce harmful emissions. And guess what? Despite the EV revolution, there are still hundreds of millions of gasoline cars being produced and driven globally. The supply side is where things get really interesting. Russia is a major producer of palladium, and geopolitical tensions and sanctions have created huge uncertainties. South Africa, another key supplier, faces its own production challenges. This isn't just about industrial demand, it's a classic supply squeeze story. The tightness in the palladium market is palpable. While the long-term transition to EVs will eventually reduce demand for palladium, that's a story for further down the road, not mid-2025. The shortage is now, the need is now. This metal has been on a roller coaster, but the fundamentals are pointing up for the next year. Don't miss out on this one. The auto industry still needs it, and the supply is constrained. That's a recipe for higher prices. This is a high-octane play. Now, what about silver and copper? For these two, I'm seeing more stability, so I'm rating them both as stable. Silver has a dual personality. It's partly an industrial metal used in electronics, solar panels, and other applications. It also has some appeal as a less expensive precious metal, a sort of poor man's gold, attracting safe haven buying during times of uncertainty. But it lacks a really compelling explosive catalyst right now. Copper, often called Dr. Copper because its price is seen as a barometer of global economic health, is treading water. It needs a significant uptick in global manufacturing and construction, particularly a strong, sustained recovery in China to really take off. I'm not touching gold specifically today, but focusing on these other metals is key. Palladium is the clear standout, the thoroughbred in this race, due to its unique supply-demand dynamics. Copper is watching and waiting for the global economy to show clearer signs of robust growth. If China truly roars back to life and global industry picks up serious steam, then copper could get interesting, but for mid-2025, stable feels right. Silver will likely continue to dance between its industrial and precious metal roles without making any dramatic moves. So for metals, it's all about palladium's shine, while others wait for their cue. Section 7, currency, currents, Aussie dollar riding high, Forex baby. Let's talk currencies because the flow of money across borders tells you a lot about global economic health and investor sentiment. For mid-2025, there's one currency that's catching my eye, and that's the Australian dollar AUD. I'm rating the Aussie a buy. Why the love for the land down under's currency? It all comes back to commodities, my friends. Australia is a massive exporter of many of the raw materials we've already talked about. Those hard grains, iron ore, natural gas, and even some of those metals. When commodity prices are strong, the Aussie dollar tends to shine. Another key factor supporting the AUD is interest rate policy. The Reserve Bank of Australia, RBA, has been fighting its own inflation battle. There's a good chance the RBA might have to keep its monetary policy tighter or hawkish for longer than the US Federal Reserve or other major central banks. Higher interest rates relative to other countries make a currency more attractive to investors seeking better returns, what we call the carry trade. Money flows to where it's treated best. And right now, Australia is looking pretty good from that perspective. This interest rate differential is a powerful tailwind for the Aussie. And let's not forget Australia's biggest trading partner, China. While China's economic reopening and recovery have been a bit bumpy, any sustained improvement in the Chinese economy is a direct positive for Australia. China hoovers up Australian commodities. So a bet on the Aussie dollar is, in part, a leveraged play on continued global demand for raw materials and a moderately improving situation in Asia, particularly China. The AUD often acts as a liquid proxy for risk sentiment and global growth expectations. And if those improve, the Aussie will fly. What about other major currencies? The US dollar, after a period of incredible strength, might be looking at a bit of a plateau, or even a slight pullback if the Fed starts to signal an easing cycle. The euro, still facing a complex economic picture and geopolitical uncertainties in its backyard. The Japanese yen, the Bank of Japan's policy remains an enigma. So amidst this mixed currency landscape, the Australian dollar, with its strong commodity links and favourable interest rate outlook, stands out as a solid bet for appreciation in mid-2025. Go Aussie, go! Section 8, Bond Bonanza Treasuries, your safe harbour. All right, let's shift gears to the often overlooked but incredibly important world of bonds. Now, I know bonds don't always have the same sizzle as stocks or commodities, but in uncertain times, they can be your best friend. And for mid-2025, US Treasuries are looking like a buy. Why? In a word, volatility. The global economic outlook is murky. Geopolitical tensions are simmering. When investors get nervous, where do they run? They run to safety, they run to quality, and that means US Treasury bonds. They are the ultimate safe haven asset. Think about the interest rate environment. The Federal Reserve has been on an aggressive rate hiking campaign to combat inflation. By mid-2025, there's a decent chance the Fed will not only be done with hiking, but might even be contemplating or starting an easing cycle, especially if inflation continues to cool or if the economy tips into a recession. When interest rates fall, bond prices rise. So buying treasuries now could allow you to lock in relatively attractive yields with the potential for capital appreciation if rates do come down. That's a win-win. Global jitters are playing right into the hands of treasury bulls. Whether it's an unexpected flare-up in a geopolitical hotspot, a sovereign debt crisis brewing somewhere, or just plain old economic slowdown fears, these events tend to trigger a flight to quality. And the deepest, most liquid and most trusted market for that flight is US government debt. Don't try to fight this trend. When the storm clouds gather, you want to be anchored in a safe harbor, and US Treasuries are that harbor. They provide stability and can help cushion your portfolio against shocks in other asset classes. Now, what about other types of bonds? Corporate bonds, they carry more credit risk, and in an uncertain economic environment, that risk is magnified. High-yield bonds or junk bonds. Forget about it for now. The risk of defaults could rise if economic conditions deteriorate. This is not the time to be stretching for yield in the riskiest corners of the bond market. Stick with quality, stick with liquidity, stick with Uncle Sam. Your portfolio and your peace of mind will thank you when market turbulence hits. Treasuries are your defensive line. Section 9. Stock market static index investing. No way. Finally, let's talk about the big one. The one everyone always asks about, the stock market, specifically broad market indexes like the S&P 500. For mid-2025, I'm waving a caution flag. I'm rating the S&P 500 a sell. That might sound scary, but listen, earnings estimates for many companies still look too optimistic to me. We're seeing margin compression across various sectors due to higher input costs, higher labor costs, and slowing demand. That means profits could disappoint. And when profits disappoint, stock prices fall. It's that simple. Interest rates are another major headwind. Even if the Federal Reserve starts to cut rates by mid-2025, they are unlikely to go back to the near-zero levels we saw for years. We are in a new era of higher for longer rates, and that fundamentally changes the valuation calculus for stocks. The discount rate used to value future earnings is higher, which means present values are lower. The days of free money fueling endless stock market rallies are over. Companies now have to deliver real earnings growth in a tougher environment. That's a tall order for the market as a whole. This doesn't mean there are no opportunities in stocks, absolutely not, but it does mean that it's going to be a stock picker's market, not an index hugger's paradise. You can't just buy an S&P 500 ETF and expect to ride it to riches next year. You need to be selective. You need to do your homework. You need to find those individual companies with strong balance sheets, resilient business models, and the ability to grow earnings even in a challenging macro environment. Some of the sectors I've been bullish on in commodities and energy might have stocks that outperform. What about other indexes? The Nasdaq, with its heavy concentration of growth-oriented tech stocks, is even more sensitive to interest rates and could face significant headwinds if rates stay elevated or if economic growth falters. The Dow Jones Industrial Average, with its more value-oriented old-school names, might offer some relative defense, but overall market growth will still be a major question mark. So my message for stock market investors in mid-2025 is be nimble, be selective, and be prepared for volatility. Or, if you're not up for that challenge, maybe it's time to be a little scared and reduce your broad market exposure. This is not the time for complacency.